All right. Hello, everyone. My name is Scott Whitehead. I'm the Chief Marketing Officer at Total Financial. And first and foremost, I wanted to say a huge thank you to everyone. I know it's a busy time of year and you get a lot of requests to come and jump on webinars, but Mike and I really believe we've got some information here that will help you engage with your clients better and give you some really good ideas that you can use today and tomorrow. So a few housekeeping items. Number one, this presentation is for you guys. So if you have a question, please put it in either the Q&A section or in the chat section, and I'll read those and then I'll play them back to Mike, and we'll interject them as we go. Hopefully at the end, we'll get some time to have a few questions and so forth. So also with WebEx, if you want to go up to the upper right-hand corner, there's a few different ways that you can view it. There's a floating panel view, a side-by-side view. I like to use the floating panel view because you can see the presentation, and then you can also see Mike and myself as well, though, I might scare a few people, but, you might want to turn me off. So our goal today is really to spend some time giving you facts and figures and some thoughts about what's going to happen later on this year. By no means do Mike and I want to make this a political discussion. We're not predicting the election. We're not doing any of that business. But what we want to do is we want to make sure you're prepared. And I think the best thing that we can do is be prepared and have data to talk to our clients about. So I'm super excited. We've got our special guest, Mike Cepeda, on the line.
Yeah.
Mike is one of our partners from Highland Capital. He is one of the VPs of Advanced Planning, and we have a really close strategic partnership with our friends at Highland. And our agents are able to access some of their incredible advanced planning tools. Mike and his team are some of the best in the business. So we're thrilled to have them as one of our strategic partners. Total does do that. We do have a number of strategic partners where we can leverage some help from other folks. So we've got, Highland, we've got Libra, we've got our friends at Blue Water. So we've got a lot of people that we can leverage and help our agents out. So with that, let me just go in. Can you flip to the agenda quick, Mike? There we go. So this is kind of what we're planning on doing today. We're going to do a little bit of Q&A. We're going to talk about the economic realities facing our business today and really kind of level set that a little bit. There is going to be some change if the blue wave comes, and Mike will definitely spend some more time on that. I think to the current count, him and his team has counted 27 of them at a minimum. So it's pretty good to know if we can get into those. And then finally, obviously, there's some really amazing planning opportunities in this super low interest rate environment. So we want you to have enough information to talk smartly to your clients and also give you ideas that you can use today and tomorrow that are really impactful. Some of them are going to be really good for today, and some of them are going to be outstanding for tomorrow. So let me kick this over to you, Mike. Talk to us a little bit about kind of the current state of the economy. I think it's good to level set there, and then we can start talking about some of the changes that may happen in the future.
Thank you, Scott. Yeah, so I think that's a wonderful place for us to start. I would like to kind of throw in there that we don't know what's going to happen going forward, right, Scott, as you said.
Right.
However, we know that anytime that there's change, it brings about opportunity. This quote here I just threw up on the screen is attributed to Ben Franklin. I checked some sources. It seems like it is accurate, but it's a really good one because it's got water and rocks in the background. It's a pretty picture with text on top of it. So it's got to be true. But I think it's also appropriate in today's environment to just start thinking about what's coming forward that's going to disrupt planning that clients have put in place or maybe put off putting in place the last 4, 5, 6, 10 years, maybe even longer. Change in our industry always brings opportunity. And the ones that are going to be successful going forward are the ones that have the opportunity, but are also prepared when that opportunity falls on their desk. And that's really kind of what we want to talk to you about today. So Scott, to answer your question you asked a moment ago around kind of like where we are, what's the overview, where do things stand? It's been a very difficult year in a lot of ways. Some sectors, of course, are doing fabulously well, right? If you're a tech company, you're doing great this year. You're loving 2020. If you're in the oil industry or the travel and entertainment industry, you're really struggling, right? So we've had a recovery. We're way off the bottom at this point in time, and hopefully we continue to trend in the right direction. But it's an uneven recovery for sure. So there's definitely winners and losers out of this. But certainly we're still in a very high unemployment environment right now, historically, particularly from where we were just a year ago, under 4%, and being over 8% today. That's a dramatic change in a short period of time. And there's a lot of byproducts of what's happened due to the COVID pandemic that is impacting our industry and the general economy. Certainly, this interest rate environment we find ourselves in today is very problematic. I'll talk about that in a little bit more depth in a moment. But we are in a historically low rate environment, which also brings additional opportunities. Again, kind of something bad over here if you're a saver, but good if you're doing other kind of planning that we'll get into here in a moment. If you've stayed invested, you didn't sell everything off back in March, you're probably pretty happy about that. The markets have done pretty well this year. If you only had that data point available to you, you'd say, oh, 2020 is a great year. What's wrong? But obviously, there's been a lot of volatility between the spring and now for us to get to that over 14% year over year return. Additionally, the debt is growing exponentially at the moment, not just at the national level, but throughout the economy at different levels, which we'll touch on. But the debt that is being baked in right now, while the government has receipts that are decreasing, is obviously troublesome and problematic. Again, the one thing that we have going for us as a country is that interest rates are really low. So the cost of us servicing that debt is not too onerous as it might have been even just a couple of years ago. So when we talk about the debt, what are the data points? What factor or what markers do you want to keep an eye on out there? And really that debt to GDP ratio is really kind of key. So just to give you an idea for scale, for those of us that are visual like myself and the way that we learn and take in information, this does not include 2020. So we've added a lot to the debt this year, again, as the revenue coming into the government is falling down. So this chart's going to look different once all that's baked in. But if you see that spike off to the left of your screen, that's World War II. We are approaching that level of debt in our economy, and we're not in that kind of wartime mode, of course. So that is problematic, and it's all coming to a head with additional entitlement spending that we're already having to wrestle with going forward. So there's a lot of factors that the government's going to have to deal with, regardless of who's in charge going forward. This is a reality that we're going to have to address as a nation. So getting to taxes, right, which is how the government brings in revenue. Today we're at a really historically low rate. You can see over here on the screen where we're below the 40% for the top tax bracket. The bottom tax bracket's kind of bumped around a little bit, but it's still pretty historically low. But you can see those are really squeezed there. In the past, we've had a really wide spread in the top and bottom income tax brackets. We're pretty compressed today. But if we need to bring in more revenue, something's likely going to change here, right? Some way, somehow, there's going to be a change in the tax code to bring in more revenue if we're not able to whittle down the debt eventually, because some of what you hear out there in the financial space, as well as the dollar, are going to start losing its grip as the reserve currency, which would be really bad for our economy. We don't want that to happen. So we'll have to respond to that as far as the global climate goes. The other thing that we're going to talk a bit further about later on in this conversation, Scott, is going to be on the estate tax. Mm-hmm. That's obviously a big talking point. I'm thinking about change. If there is no change in the administration after November, I don't anticipate much of anything changing here or today. However, don't lose sight of the fact that the current law that we have today, this 11.58 million per life, that's indexed to inflation. That is set to be cut in half on January 1st of 2026. All that has to happen is nothing for that to occur. Congress is really, really good at doing nothing. So we really should be planning on that happening. But if there is a change in leadership, it's very possible, if not likely, that change could happen as soon as next year. So depending upon the makeup of what Congress and the White House looks like in the end of January of next year, they can very quickly pass something in 2021 and make it retroactive to January 1st. So just be mindful of that as you're having conversations with your clients around planning and what they want to do going forward. And I talked about the general rate environment being super low. This is the 10-year rate, and why this matters for us in the insurance industry. This is a big asset class that carriers go to deploy premium dollars to. So if you have a large first-year premium 1035 exchange coming in to a carrier, doesn't matter who it is, they get that money, they pay out commissions, they have cash value in the policy, they have to go pay reserving on that death benefit. They're also paying out excess compensation, and then they're going to go take what's left over and go invest that in the market. Well, if they're paying out 4 or 5% on excess, and they're going to go and earn 60 basis points on that money, that's really, really tough. Regardless of what they're doing with that money when it comes in, whatever's left over in their portfolio, this is a big place for them to go and invest those dollars. Going back just 2 years from today, almost today, over 3%, almost 3.5%, I believe, it was 3.24 we were at back in October of 2018, and now we're at 60 basis points. That's a really difficult investment environment for a carrier. I do not envy the teams at all, the major carriers that are trying to figure out where they're going to go and deploy their capital. It's problematic, but that has a trickle-down effect in how they price product, what limitations they might put on single pays coming in. We've seen that already today. They're responding to it. The Fed just came out, I believe, less than an hour ago and said that they anticipate rates being held at the current level for at least 2 more years. So this is not likely to change. This is going to be something we're going to be dealing with going forward, at least for several years. And even if and when it does start to pick back up, it's going to take some time. It's like steering a battleship in a harbor. Meanwhile, we've had all this going on the Treasury side, and the debt side of the house, and the equity side, we've been doing pretty well. A lot of volatility, huge drop off in the spring, big recovery since then. If you stayed invested, you're probably pretty happy with where you've gone. And just as a little fun aside, and Scott, I don't know if we even talked about this. This bottom line down here, the red line, that's the S&P 500. This top line's Tesla. So if you stuck in there with Tesla, again, a lot of volatility, but huge growth. But it just kind of goes to show the disparity between what the debt markets are able to earn today and what we're actually seeing in the equity market. And the background of all this, of course, is the COVID pandemic that's affecting every country in the world. So interesting times, very unique for sure.
Oh, absolutely. That's a rather interesting chart right there. So the blue wave. Why don't this is where, when I said earlier, we're not making any predictions. We don't want to get politics into the game here, but we want to get you prepped. So, Mike, spend some time here talking a little bit about what the blue wave is, kind of what it could mean, and especially, and I know we're gonna break it down between income, business, and estate taxes. But why don't we kind of start on the blue wave and what we think that's going to do?
Right. So, anytime that we're in an election year, there's a chance for a change in administration and then a change in approach in their, theory on governing and taxes and spending. So things have almost never been more disparate than they are today between the two major political parties in this country and how they might, manage and how they might run the country. So, if we're in a position where we're having changes in administration every 4 years, we're going to be on the seesaw, it seems like, constantly, unless something changes here. But certainly there's not too much that has to happen in order for, assuming the Democrats take control, that is, for them to be able to pass increases in tax legislation. Unlike reducing taxes, where you need a filibuster-proof vote and you need to offset the reduction in income to the government, meaning taxes, with reductions in spending. If they're going to raise taxes, that's really easy for them to put through. They just need a simple majority. So it's not going to be too difficult for them to push something like that through. Again, you saw on the agenda, there's 27 distinct tax changes in the Democratic proposal for how they would apply tax changes to the government going forward and to corporations, estate planning, income planning, et cetera. We'll go through some of those key ones. We're not going to go through all of them today, but it would not be overly difficult for them to do something quickly in 2021 and again make it retroactive to January 1st. And I think something to keep in mind is that, or I just mentioned this about the control of the Congress. this is something I think we need to also be very mindful of, and I want to draw everybody's attention to. I don't care what happens in November. The states are hurting right now. Their spending is through the roof. Their revenue is way down. They don't have the same tools at their disposal that the federal government has, and so their way to grow revenue, meaning taxes coming into the coffers, is a pretty blunt instrument, and that's just to raise taxes. So whether you have a Democratic or Republican controlled state, they're all struggling. They're all going to have to figure out ways to raise taxes. They may do that in a variety of ways. It could be sales taxes, it could be income taxes, it could be taxes on investments. It could be a combination of all those, plus maybe even additional transfer taxes. Maybe they'll unlink from the federal and put in their own systems in place. Could be a mess. And you're really going to have to pay attention to what's going on in all the states where your clients reside at and where they own property. Because my guess is that we're going to see a lot of different changes out there. It's not going to be uniform. It's just going to make our lives a little more difficult. But that also is opportunity for us to help our clients make good decisions with their planning. So just be very mindful and watchful of that. And the other thing I just want to draw attention to is kind of, well, why are we talking about this? Again, it's not, there's no political, conversation here today, but really why this matters though is that when you look at what's going on in the polling, which wasn't great 4 years ago, as far as aligning with the results, the dynamic of those polling and the odds that are being placed out there, kind of where things are today. We saw at least 3 presidential debates and a VP debate yet to go. Things can change dramatically. But as of today, 538.com, Nate Silver's company, they're predicting a 76% chance that Biden wins. And obviously we don't, the Senate is a little bit different on how those votes would go. But that polling looks to also be favoring blue at the moment. So the odds and chances that we have a change in leadership in the House and White House, that is, and in the Senate, look very possible. So we really need to be, pay attention to this and take it seriously that these changes could come. And then we could wake up on November 4th and say, well, okay, well, no changes, right? But that remains to be seen. But it's really a good idea to start thinking about this and the opportunities that might be there for you, the challenges your clients are going to have, and ways that you can help them solve those challenges. So let's take a moment, Scott. We'll talk about some of the key provisions in here that I think will be very interesting. A lot of you may have already seen some of these, but I think what's really going to be interesting, of course, we know the top tax rate, right? That's going to go back up to 39.6. Right now, they're saying no other changes. Again, this is if we have a blue wave and the Democrats are in control and they can push everything through. Capital gains, if you're making over $1 million in their proposal, you're going to be at your top ordinary income tax bracket instead of 20% plus the Medicare 3.8. Right now, itemized deductions are unlimited. However, what Democrats are proposing to do is to basically say, well, you're only allowed to deduct as if you're in the 28% tax bracket. So for every $1,000 deduction, that's a $28 or $280 benefit, as opposed to being at almost $40 with the top tax bracket. Qualified plans, it's a little unclear right now how the Democratic proposal would work, but it is potentially a really big deal. It could be that they put into place a crediting system that will credit your account as if you're in the 26% tax bracket, regardless of what tax bracket you're in. So if you're below that level, it's going to be a benefit. But if you're above that level, your deductions, that your contributions to that plan, your deferrals of income, that deduction is not going to be as valuable to you. And if that were to happen, it's going to be really interesting to see how high income earners are going to think about saving for retirement and where it makes sense for them to put that money. So that again could be a really good opportunity for the insurance plan space because of the unique tax benefits that our products have for savers. And then the other thing that's really going to be I think a double whammy in both the income and also on the corporate side, it's going to breed multiple ways of opportunity, is the proposal on essentially what's being referred to as a donut hole in the Social Security tax, where right now that goes away after you get to $137,000 of income. That 6.2% tax you pay is now gone. That's great for everybody who makes more than that. However, what the Democratic proposal is that would come back at $400,001 and everything above that. not just for the individual making that income, but also for the corporation paying that. So think about that. CFO sitting out there wondering, geez, how is this going to affect now our budgeting going forward? And geez, that person who we're paying $1 million, they're costing us a lot more money today. It's also going to be a lot more income taxes being paid by that individual. So there may be a mutual interest there to do some deferred compensation planning. Should all of this come to pass, I think that's going to be a really, really big opportunity. If you have the type of relationships where you can work with the C-suite, HR directors, that could be a fantastic opportunity for you going forward. Just a quick note, the impact here on the top 1% is projected to be between 13 to 18% more in taxes under the Democratic proposal. So that's a big change for people that are making a lot of money in this country.
That's a big number.
Did I scare everybody yet, Scott?
I think everybody might be a little scared. I think one of the things that we talked about, and what I had said earlier is we want to make sure we give you good information, but we also want to give you some usable ideas. And most of the folks that I know that are on the phone, we're life insurance professionals, right? This is what we do. We know how great that life insurance is as a vehicle, and I think this is probably a good time to maybe step back into the basics and maybe even get back into the cash value side of the life insurance bit, and where that fits. And I don't know, Mike, what do you think? Where do you see life insurance fitting in on that income side and the personal side?
Yeah, that's a great question, Scott. If it's not apparent or obvious, anytime that there is a higher tax environment, right? The life insurance product with its inherent tax benefits becomes a lot more valuable and attractive, right? So I mentioned the piece in the qualified plans and how that could be less attractive to high income earners as far as deferring compensation due to the loss and deduction. It's not as valuable to them anymore. Would they stop contributing? I don't know. That remains to be seen. But if they do, they're going to be looking for other places for tax advantages. We have great solutions for them, great products. We have contracts, of course, like whole life, non-correlated to the stock market. Variable is an option for some clients. NCUL might be more appropriate for others, right? There's a broad risk spectrum of things that we can put in place for them that work differently but accomplish objectives. But there's also a huge gap in what people really need from a life insurance death benefit protection standpoint and what's actually in place today. So, if this is the way that we engage clients with that in that conversation and take it from the tax advantage route, we're also going to be doing something really good, which is putting a lot more face amount in place to help protect those families. And I think that's something that we can all be proud of in what we do in our industry. I forget the exact ratio, Scott. I'll follow up with you on it. But the amount of money that goes out to beneficiaries from the insurance industry relative to Social Security is not as different as what you might think it is. I think it's somewhere like around 60% of what Social Security pays out. It's a huge driver of money going out to families. Of course, obviously that's tied to a claim, but there's also tax-free income and return of basis and loans that clients get, and then they go and spend in the economy. So it's a really big deal.
Yeah, I'm a huge believer of this. I mean, 28 years in the industry, I cut my teeth on the VUL world, Mike. That was a long time ago. And I was at Allianz for years learning about the index and really talking about the IUL and where that fits in the marketplace. And I think right now it's a great opportunity, especially for IUL. Your premium dollar can do so many different things. It buys your life insurance. It gives you the access for that tax deferred opportunity, the tax advantage opportunity. With these great living benefit riders on these policies, you could have some of that long-term care, some of the DI coverage, and it really can be a kind of a Swiss Army knife planning tool if it's done properly. And especially with IUL, you get that downside protection, take some of that volatility away, and you get a little bit of that capture of the upside. I just think for right now and looking forward, it's still a great tool. It really is.
Yeah, absolutely. And I completely agree with you, Scott. Adding that living benefit feature on there is just a huge plus. It's creating awareness around that for consumers. I think is something that as an industry we've gotten a lot better at, but we're not all the way there yet.
Yeah, I agree.
Yeah, that's another area that I think there's just so much opportunity for growth. I think we've seen that already the last couple of years. I think it'll continue to ramp up. So selling it as a package with everything else that insurance does is something that's really in the mindset of how people buy things today, and that you want to get something in a bundle, right? Well, here's your Apple One bundle or whatever they call that program they released yesterday. All right, we can do that too in insurance. Marketing people are far smarter than you and I. They'll figure out a way to package that up and sell it. But that's the thing that we need to try to do, and we have the tools at our resources to do that. But we just need to figure out a way to get that message across to consumers.
Oh, fully agree. Why don't we switch gears a little bit and start talking a little bit what a Blue Wave would do to the corporate and the business side? Because I know a lot of people on the line deal with small business owners and corporations.
Yep. Yeah, great. Let's do that. I don't want to spend too much time on this because I kind of want to get into what the sales opportunity is after that.
Yep.
But as far as before, we were at 35% on the corporate income taxes. Through the Tax Cut and Jobs Act, we went down to 21%. There was a lot of deductions that were then also removed. Those would stay in place under a Democratic administration, but that rate would go from 21 to 28. So not a huge move there. There would be some impacts to pass-through smaller businesses with the qualified business income deduction. Those flow-through entities, they would start to lose some of that ability to deduct their taxes at above $400,000. But really think about the comment I made a moment ago, Scott, about the Social Security wage tax and also just a higher income tax bracket. And executives in businesses, right, the CFOs, the accounting departments are going to be saying like, geez, now this person's costing us so much more. There's going to be mutual interest there potentially to do something about that, right? Which is what we call, deferred compensation. So, real quick, because we have a lot of content yet to get to, what does that mean, right? So anytime there's higher taxes for top earners, businesses should get together with them as a benefit to figure out a way to help them ease that burden. There's a lot of different ways to do that. One of the simplest ways is just set up a salary deferral program, right? And that can either be informally or formally funded. You can utilize life insurance for that. It can be an asset on the book that's now neutral if you use a true COLI product. And it could even be additive to the balance sheet. So you bring that kind of story to a CFO, and they're going to love the idea of that, right? So not only are they saving on all this extra tax that they otherwise would be paying, they are now putting that money into a program that's going to actually add value to the balance sheet. And their key executives happy because hopefully in their mind, they're not paying 39.6% plus 6.2 on these excess earnings that they may not really need today for living, for savings, for whatever, with the idea that I'm going to get that in the future when I'm at a much lower tax rate. Maybe I'll be at 28%, and I won't need to be paying that extra Social Security tax on top of that. That's a huge economic shift for them on that income. So again, remains to be seen. But if all this comes to pass, that's going to be a huge driver, I believe, where we'll see a growth in insurance planning in 2021 and beyond. And again, how that works, real quick here, just on the distribution of the income from the company. At that time is when the company gets to take the deduction. So unlike a 162 bonus plan that might be put in place today, where they do get a deduction on the premium payments that are made, with the salary deferral plan, where it's true deferred comp, they are not getting a deduction today. That's only in the future when they end up paying out the benefits to the executive who's retired at that point in time. And the employee owes taxes at that point in time as well.
So this is it's an oldie but a goodie, right? I mean, deferred compensation, executive benefit planning has been around forever. I think for those of you who have C-suite clients and are in tight with the advisors to the C-suites, you want to start planning now and getting on their books now. I think it's going to be a really big opportunity to go from, it's something that we all know and we've all used before, but I think the opportunity is going to be even greater than it has been before.
Yeah, and Scott, one last thing on that. I will say that I know planning specialists in this place now, they are very busy at the moment because CFOs that are looking at this and saying, okay, well, if this were to happen, I want to have my ducks in a row, right? To start getting that planning in place and knowing what they need to do to execute on something. They're already having those discussions. So the sooner you can get in there, I guess my advice would be, don't wait. Again, we don't know if this is going to happen or not, but if you bring the idea to them first, you have a much better shot of earning that business. So don't wait, don't walk, run now, have those discussions and in that dialogue and position yourself as the go-to resource to assist them.
Yeah. Oh, absolutely. All right. So once again, let's shift gears over to the estate side. And I think the estate side, I don't know. I just think there's going to be some incredible opportunities for today. I mean, really talk about some things that we can do today and tomorrow. But from our industry, if this does happen, I think if we're not planning now, we're behind. So why don't kind of roll through the estate and gift tax potentials, and I think this is going to be huge.
Yeah, and a lot of this stuff sounds like really like, oh my goodness, like, are you kidding me? This is gonna crush us in some ways and help us in others. I've had conversations with multiple agents who've been in the business for 40 plus years, and they can regale us with stories about, well, this change came out, that change came out. It was going to be the end of estate planning, the end of life insurance. Never happens, right? Again, change brings opportunity is really the moral of the story from those experiences. So what we're looking at here, we don't know exactly. Some of these provisions have been spelled out by the Democrats. Again, this is should they take control and be able to pass whatever they want. Regarding the estate tax exemption and the rates, all that's been said is that they want to return to a historical norm. What the heck does that mean? We don't know exactly. 3.5 million per life has been a number that's been thrown out there multiple times over different periods by the Democrats that they would like to get back to. But if you look at a chart like we showed earlier, I mean, we've in the recent history, we've been at 600,000 in the million. And then when Bush came into office, that started ratcheting up. Obama kept it ratcheting up. Trump took it to a whole new level where we're at today. So there's a huge opportunity here to move wealth. And again, remember, regardless of what happens in November and subsequent elections, 2026, this is set to sunset down to at least half of where we're at today. Or I should say half of where we are in 2025. So huge opportunity to make lifetime gifts for those families that are at the level of wealth that they can afford to do this and it makes sense to give up control of those assets. Many of them have already done that, which, by the way, is a great place to go find liquidity for insurance premium funding. Existing funded trust. Easiest place to go get it. Because what we're going to see in the future here, should this come to pass, is that it's going to be a lot harder to find ways to fund trust. So why is that? Well, if we earn a 3.5 to 7 million for a married couple, that's left lifetime exemption that can be transferred now. There's also a provision in there where they would limit how much each donor could put into for gifts. So today you can do $15,000 per life, $30,000, as a couple to each beneficiary, and it's unlimited how many beneficiaries you can have. Well, if the Democrats get control and they put through what they want to put through, it doesn't matter. They're going to cap you at 50,000. Now, not every trust out there is funded with annual gift exclusions, but a lot of them are. Clients like doing that for simplicity. That could impact planning that's in place today. Right? That's not a grandfather thing. So if that's how they're funding insurance programs today, and you have cases like that are out there, you might want to go have a conversation with the estate planning attorney that you worked with to set that up and talk about, well, what can we start doing now to get liquidity into that trust to fund those future payments? Because we may have trouble and challenges ahead of us with getting that money in there. So now is a great time to start thinking about that. The step up in basis, I think, would be a complete mess administratively. I'm not sure how they're going to do that. But if they're going to start taxing on the step up in basis as opposed to letting the growth on assets when they're transferred versus doing the step up in basis, CPAs their heads are going to explode. Well, yeah, they're going to have a lot of billable hours, I should say, Scott, but it's going to be a mess.
It's funny you said, walk, not run. How about getting into that Tesla that you had in earlier and drive really fast to your trust planning reviews? because I think this is a huge opportunity just to go back and do the good old fashioned trust reviews, policy reviews, and ask the questions on how they're funded. Mike, before we jump quick, I have a really quick question. Somebody asked if they could have this presentation when we're done. You and I didn't discuss that, so I don't know if you want to ask me now, and I can get back to them offline, but that's up to you.
That's fine, Scott. And we'll also have a recording of this too.
Yes.
So.
Yeah, absolutely. So you've got some good numbers here. How about I know that the next slide is on private financing, and it's something that you and I have talked about many, many times. Oh, no, you got more numbers. I'll get to private financing in a minute.
Yeah. Well, so staying with the estate taxes, I'm sure that's a big, item of interest for our audience, Scott. Column 1 here, you can see the 23.16 million is where we are today. Going forward, if we have a sunset where it's halved, again, this is for a married couple, you can see the difference here that where this family would owe no estate taxes under the current regime, but come 2026 with the sunset, they would owe 4.6 million. If the Democrats come in and they get to $7 million, all of a sudden now overnight, they go from having no estate tax issue to 6.4, right? So that's a huge shift. Hopefully not. I know there's a lot of talk about this around, oh, well, hey, you no longer have an estate tax issue. Let's go and lapse that policy or maybe sell it on the secondary market. Those are clients you definitely want to be revisiting and having discussions with, because they may not have the requisite liquidity available to pay the IRS in 9 months should there be a need to. So just buying life insurance for those estates that were today not exposed to the transfer tax, but may be under a Democratic regime, life insurance is going to be the cheapest, easiest way to fund that. And believe me, I think we'll see, my guess is, we'll see a lot more survivorship product development out of the carriers. Maybe they'll just dust off the old ones that they threw away, update the CFO tables and the reserving, and put those things back out there, because they'll definitely be that'll be a driver should we have a law like this in place.
Oh yeah, I've actually started to see a few of our carriers kind of jump back into that marketplace. Before we jump a little farther, we got a really, really good question that's a little bit of a sidetrack, but I think it's important as we're talking about life insurance. Have you heard anything about the buildup in life insurance and annuities? Has there been any conversation about that?
No, I have not seen anything about that, Scott. I know AALU is very busy right now with their virtual annual meeting that's running several months. But they're usually all over that, and I have not seen any indication. But that's a great question. That thought had occurred to me as well, but I have not seen anything on that. And our industry has done a great job fighting that back in years past. And we have a really great advocacy program and people that maintain relationships with key decision makers in Washington to help, educate them on the value of life insurance and why it's so important to maintain that provision. But certainly, yeah, that is an item that has been out there, that has been on the list. If memory serves, Scott, I believe the lobbyists for the insurance industry were able to get that preferential item off of that hit list as something that they would consider, going to help raise revenue. So I think we're probably in a better spot today than we were several years ago, even when it comes to the idea of taxing inside buildup. But good question, yeah.
Yeah, thank you. You can jump back into the
sure. Yeah. So we talked about this already a little bit, but if clients have the means to utilize the increased gift exemption today, they really should figure out a way to think about doing that. One really good, easy idea, and we're not going to touch on this in detail, so I'll just talk about it now, Scott, is what I would call the wait and see gift. Mm-hmm. Utilize a private loan to a trust, right? The client's the grantor in that case. They can go ahead and pull that back at any time, but they can also be very nimble and strategic and simply forgive that loan and make it a gift, right? So that way that they don't use that increased exemption.
Yeah,
so simple. Something to think about there. But the other thing too I'll mention is just what we are hearing is that T&E attorneys are just absolutely crushed right now. I'm not sure exactly what's driving that, but what we're being told is that clients are getting their affairs in order. They are getting their financial affairs in order, not just because we have a health pandemic going on, but also because they are planning for change. So if you don't wait till the last minute to get to your T&E attorney to put together documents this year, because you won't be able to see them. You got to get in there probably before Halloween if you want to get into their calendar.
Again,
so it's another run down walk.
Nice. Well, did you want to turn the tables a little bit to? Are you going to do defective grantor trust and then private financing, right?
Yeah, I'll just make a quick comment because one of the other things, the defective grantor trusts are a staple, very popular planning technique for us to use, and really why wealthy clients love these is because they are still on the hook for the taxes, and that becomes a tax-free gift for them, as opposed to the trust picking it up. One of the things that's in the Democratic proposal, and it's not clear if they would grandfather this or not, which would be a complete mess, would be doing away with grantor trust status. So that's something that definitely bears watching. I think that that's probably not something that's going to really change the revenue discussion. It's more about kind of protecting the wealth transfer system. So that's something I think could probably get negotiated out. I don't think that's going to be something that anyone's going to, it could be a political football ultimately. Yep. But it does bear watching because that would be a big change in how existing plans are set up today. And again, change opportunity, but with the grantor trust status, again, that grantor being able to pay the tax, let the tax otherwise stay in the trust is a huge benefit for very affluent families. So that's just one other thing that bears watching. So Scott, we can skip now to private financing. You've been anchoring for it.
I know, it's all exciting. Actually, honestly, I can chuckle about it, but if you have high net worth clients, what Mike's talking about in the next couple of minutes is real. I've had so many conversations with our agents and their clients. This is such an amazing time to be talking to those high net worth clients with those low rates and this strategy. It's huge. So I'll let Mike go on this one, but it's huge.
Yeah, and I'm going to show you a chart here in a moment to kind of put this in perspective. But last night or yesterday at some point, the AFRs for October came out. They are a little bit higher than they were in September, but September represented the low point. Long term at 1%, which means a lifetime loan. That's ridiculous. It wasn't that long ago that we were at well over 3%. And now it did go up a little bit. I mean, magnitude of change is pretty significant, going from 1 to 1.12. But that's still a historically low opportunity. You shouldn't freak out that that's going to start going up significantly here in the very near future. But it moves around every month. It bears watching. Same with the midterm rate, that 30 basis points that we're going to have for October. Huge opportunity. I never really see much in the short term space getting used, but 14 basis points is essentially nothing. So to kind of put that in perspective, with the long term, where we've been since 1996, back in 2010 still. About 10 years ago, we were at almost 4.5%. Today, we're just over 1%. Back in 2018, we were at over 3%. And that is a huge difference when you'll see where we go through a case study and determining how much a client needs to contribute to the strategy to get the funding that we need to satisfy the insurance premiums to accomplish their wealth transfer objective when it comes to the death benefit. So regarding private financing, Scott's favorite topic, kind of how it works and why clients are so attracted to this. Especially think about not only today where this is very attractive, but also going forward. Remember, we talked about the exemption coming down significantly as one of the possibilities that we could see in the future. That is also something that's going to limit how much clients can put into a trust to do insurance planning, right? That should concern all of us, right? How are they going to fund the premium? Same with the annual gifts. That's now capped at 50. That's just another tool that's taken away. So how do we get money in the trust to pay the premium? Private financing is a great option today. And to Scott's point, it's going to be a great option tomorrow too. So there is no gift issue here, right? We are transferring the ownership of a policy via a loan to a trust. They get the benefit of the appreciation. They get the benefit of the growth above and beyond what the note rate is. So if it's a long-term note, we're at 1%. If it's midterm, we're in the 38 basis point range. And again, that changes every month. So if a client has used up all their lifetime exemption, or they're just limited because we're under a new regime that is much more restrictive, private financing is a great go-to. Estate planning attorneys love this. Clients' financial advisors like this as well because they get to continue to manage the assets potentially, depending on what it is that you're putting in there. And really, all that we're looking for is something that produces growth and liquidity, right? Real estate can even be used, although that's a little tricky with some tax issues. Which, by the way, there's also a lot of really punitive tax to real estate investors, getting rid of the 1031 exchanges. There's also a limitation on what they can write off. I don't know if that's just Biden being, angry at Trump for things that he's done and saying, well, I'm going to go after the real estate investors. I don't know what their end game is there, but yeah, those are some punitive things too. So that bears watching. If you have clients that are big real estate investors, be mindful of that because that's in the proposals for the Democrats too. So part of why this is just so attractive, and Scott, I wanted to touch on this real quick and we'll get into the case study.
Yep.
The client always has three options. They can keep the loan in place, right? Mm-hmm. So if you do a long-term rate, but you really just intend to be there for 9, 10, 12 years, they can keep it in place indefinitely if you do the long-term AFR. They can always forgive that loan, as I mentioned before, and make it a gift. And they can also get repaid at any time, right? Because they are acting as the bank, right? They're the ones loaning that money. So they are in control. Clients love that. Estate planning attorneys love that. And what I'd like to talk to you about in just a moment here is a case study. And really the moral of this story is don't be afraid to propose something that looks like it's a really big number, because remember, the client's going to get this money back, right? This is still due back to their estate. It's not out of their taxable estate, and they're going to owe, estate taxes in the future on this money. It's all about what gets to stay in the trust, which is what we're going to use for the premium payments, and then also the death benefit. All that's going to stay in the trust and any additional growth. So in this case, we have a client that's in her 70s. She has an asset that is kicking off close to 12% of income. We're assuming 6% to account for some volatility and also reduce and be a little more conservative on our assumptions there. But in this case, on a midterm loan at 35 basis points, the client would need to put in $45 million today to fund the insurance premium to get the $40 million of death benefit. Again, don't get freaked out that these are really big numbers, because what I want to try to drive the point home is that going into this meeting, I was thinking that, geez, that comprises about 45% of this client's investment portfolio. They're not going to be interested in this. I'm going to show them a long-term one. We're going to really drive down that number. They're going to be at a 1% note rate, but that overall commitment is going to be a lot lower. The attorney loved the midterm, and so did the client, because of the idea that they could control and have money back sooner. So they're okay with putting in a bigger proportion, knowing that they're going to be able to get it back, where the long term, they're really committing it, until the end of the planning. The other thing that really helps in this strategy is that if you can layer in a gift in addition to the loan, it also really drives down what needs to be contributed. And again, if it's a use it or lose it proposition with that lifetime gift, making that gift today can make a lot of financial sense anyway. But this is a way to help layer in both gifting and private financing to get the planning done. So just remember, there's always multiple tools at your disposal. And with something like this, frankly, too, because of all the cash that's sitting in there, if you needed to go out and borrow money from a commercial lender, you have a lot of collateral in there. So it doesn't really matter what product you're using at that point. You're not going to need to tap into the policy cash value for collateral. You have a lot of cash in there already. So a lot of things you can do once you start to fund a trust like this, and just, brings the door open for a lot of really great planning.
Yeah, a lot of flexibility there. I think that's the key to private financing is the flexibility piece of it, and the ability that now they can take advantage of those gifts. They can take advantage of holding the money. If you're a money manager out there, the fact is you get to keep control of that. And or if you're working with a money manager as a center of influence, it's a huge sell point for them. So this is, we've seen a lot of this at Total. We've seen a lot of it. Mike and I have talked about it a lot lately. And it's a hot topic right now, real hot topic.
Now, Scott, I noticed we're running short on time here, so maybe I'll just kind of jump around a little bit.
Sure.
Go quickly here. I'm going to skip over the funding hierarchy, but just know that for those of you that might get these slides later or listen to this recording, you can always pause here and look at this in more detail. The ones that are highlighted in red here are really ideal in a low rate environment that we find ourselves in today, and also going forward into the future. Some of these we're talking about here in the call, but think broadly when you're thinking about how do we fund for the insurance solution, right? There's multiple ways to do it. You just got to find out what the client has and line up to their objectives and what makes financial and economic sense for them. So Scott, I know you wanted to talk about those SLATs.
I do.
SLAT planning. So.
I think SLATs are a really interesting topic. A lot of people talk about them, not a lot of people implement them, and I think there's probably a lot more opportunities for clients to implement them, especially with what we're going to see. I think this might be an amazing planning tool. And I know you've got a case study behind here, so if you want to roll through SLATs a little bit, I think this might be interesting for the audience.
Yeah, so Scott, in my experience, a lot of agents out there, they get a little bit confused about SLATs and then dual SLATs, and then you have this, the concern about the reciprocal trust. But really what to know with SLATs is that it's an irrevocable life insurance trust with some additional provisions written in there that can help to maintain some control and access to that money during the lifetime of the grantor spouse. Mm-hmm. So
access, keyword access.
Yeah, it's really important. So when you think about those clients that you have that are not really candidates to say, hey, I'm going to take full advantage of this really large lifetime exemption that we have today and do the full gift. Maybe they want to do some of that gift or maybe load it up on one spouse, knowing that if they have these provisions in the trust, that there's going to be a way to get cash flow back to the spouse should that be needed. And again, I just maybe to emphasize this point, Scott, is that it's really about if needed. This is not, hey, we're going to do this planning, get this money out of our estate, and it's going to be a retirement fund. That doesn't work that way. This is really just as needed. So I put in there, the HIMSS, the health, education, maintenance, and support of the spouse, right? So it's going to be at the trustee's discretion. But ultimately, just know that attorneys know this stuff. They're not going to mess up the reciprocal trust if you're setting up two of them and proposing that. And they will put provisions in the trust that suit the situation of the clients. And it's a really great planning strategy. Again, for those clients, if you need to get them over the hump to do the planning, make the gift, if that's the right thing for them to do. Of course, work with their CPA and attorney and craft out that plan and figure out what the right amount is. But this is a great way to get them comfortable with doing that planning that that they will benefit from. A way to think about this. Well, I'm going to get through this just in the interest of time, Scott. So
sure.
When you think about, again, I just want to share the mechanics here because we only have a few more minutes on the dual spousal lifetime access trust. This is a means to, again, move that wealth. And in this case, we're showing a family that with a $60 million net worth, they're going to take advantage of that full gift. So they're moving the $11.5 million into trust for each other. They're going to buy life insurance, individual life insurance for $7.5 million in their respective trust, and the other spouse is going to be the beneficiary of that trust. So that's pretty straightforward. It's very simple. The beneficiary is, again, the other spouse. It's going to be subsequent generations as well. So you may have some GST issues in here that you need to be mindful of. And you could have survivorship or single life coverage in these trusts. Now, I think the next thing that is really fun to consider then is, well, what if they really want to avail themselves of the pricing benefit of having a survivorship product and that really kind of fits their planning objectives better? You can still utilize the SLAT, and survivorship trust can be set up as a permissible beneficiary of the SLATs, and the SLATs can then help to fund that trust. So if you made the gift into the SLATs can then go and put funding into the survivorship trust to fund the insurance premiums, or they can loan assets to the survivorship trust to help fund the insurance premiums, and that can be a really huge benefit. This kind of structure for high net worth families. If they don't need that liquidity at the first death, this is probably going to be a preferable way to go. So again, instead of having the insurance inside the SLATs, it's in the survivorship trust. They got liquidity in those first two trusts that they set up. And again, don't worry about the reciprocal trust. The attorney, that's 101 for them. They're not going to mess that up. So Scott, I don't know if there's any other area that you wanted to quickly highlight on. Or if we had some questions we wanted to get to.
Yeah, we've kind of caught most of the questions as we go on. So just a reminder, if you got a quick question, you can throw it in the chat button over there. But if there is no questions, I'm going to have Mike just kind of do a quick summary, and then before you guys jump off, I want to talk a little bit about what's next. We've got a couple of other educational tools that you're going to want to get a hand of or get to know once we're done with this. So I'll let Mike wrap up here, and then we'll talk a little bit more in a second.
Great. Thank you, Scott. And thank you all for attending. And Scott, thank you for inviting me to participate. Really appreciate it. I enjoy these kind of conversations. So in summary, again, we don't know what change is going to come, but change is coming. It may be really significant in magnitude. It might be smaller. Don't lose sight of what's going on at the state level going forward. They have budgetary issues. The federal government obviously has budgetary issues and revenue issues. So something's going to give there eventually. There's going to be change. We just don't know the magnitude of it. And we don't know exactly when that's going to happen, but it could be very soon. So that's the basics. Focus with your clients on the inherent benefits of life insurance. Think about living benefits. Think about how you're going to fund trust into the future. And that might be a today thing, right? Think about getting that funding in there today, even if the insurance is in place until 2021. Get that funding lined up, because we might have our hands tied in different ways going forward. Private financing is a great opportunity today. It's going to be a great opportunity, and maybe even the preferred or primary way of funding trust into the future, depending on what limitations we have. The executive benefit space, could be a huge growth opportunity if the corporations and executives are dealing with a significantly different tax environment collectively. They're going to want to look for ways to minimize their taxes. Deferred comp is a great way to do it. Charitable planning is still a great concept. There are some limitations that the Democrats are proposing to put in there that could lessen that benefit, but it would still be an economically meaningful deduction for families, and also a good thing to do.
Oh, absolutely. All right, so a couple of follow-up items for us. So we are going to do 3 of these large town halls. The next one is, sorry, my phone's ringing. The next one is in November, and we're going to do longevity planning. And then the follow-up in October's longevity, November is product planning and kind of looking at where the product landscaping is. What we wanted to do with these town halls is have virtual workshops right after them, where they're smaller, more intimate, give you a chance to dive in deeper, talk to Mike and myself a little bit more, and then actually talk and have more of a roundtable with your peers. So we have 2 of those scheduled, one for next week on post election economic changes, one with Mike, and then I'm going to do one just on how to target estate planning prospects, and that'll be on Thursday. These are limited to 15. We want participants to participate. We want conversation. We want the roundtable feel. And so you'll get an email on that once this presentation is done. They're limited to 15. If we get more than 15 people that want to do these, we will add other ones to the sessions. So with that, I really want to thank Mike Cepeda. This was a great presentation. I feel like we've got a lot of things that are usable. Just a reminder, Total Financial is your insurance solution. We know how to deal with these, the small cases and the large cases. Is something that we've been doing since 1970. We're really good at it. If you have a case, a question, a thought, feel free to give me a call. Our phone number is 1-800-989-7500. My extension is 256. You can go to totalfinancial.com. We have a lot of great sales ideas out there. Mike and I have actually done a couple of podcasts together on premium financing. So if you go to SoundCloud and check out our the Total Financial podcast channel, there's Mike and I with a couple of ideas there. Plus, there's another 4 or 5 other podcasts. So we have a lot of tools to help you. But I think just to close quick is the information we gave you today wasn't to scare you, it wasn't to play the political card game, but it was to give you information to engage with your clients, give you things to talk to them about today and for tomorrow, and give you some really core planning ideas that you can still use today, but a couple of them are just absolutely going to be spectacular should this blue wave happen. And so that was kind of our goal today. Hopefully we did that for you. We will be sending out the slides and the recording, and those will be available. So with that, thank you, Mike.
Thank you, Scott. Thanks for having me. Appreciate it.
Absolutely. And have a great week. And we look forward to seeing you on our next town hall and our virtual workshops coming forward. Thanks, everyone. Have a great day.
Thank you.
Thanks.